The dollar is dying, and you're watching it happen in real time, not with a bang, but with gold bars stacking up in Shanghai vaults and digital ledgers recording trades that never touch New York. This isn't conspiracy theory anymore. This is 10 nations controlling 45% of the world's population, making a calculated bet that the 70-year reign of dollar dominance is entering its final act. Right now, at this very moment, the BRICS alliance is building financial infrastructure that doesn't need American permission to function. They're not asking for a seat at the table. They're building their own table, and 40% of global GDP is sitting down at it. The numbers tell a story that most people aren't paying attention to. The dollar's share of global reserves has fallen from 72% in 2002 to 58% in 2024. That's a 14 percentage point drop, and it's accelerating. Here's what makes this different from every other challenge to dollar supremacy. This isn't one rival currency trying to replace the dollar. This is a coordinated block of nations creating parallel systems that make dollar dependence optional rather than mandatory. They're doing it with gold. They're doing it with bilateral currency swaps. They're doing it with blockchain-based payment networks that bypass SWIFT entirely. The chess pieces have been moving for years, but most people only started noticing when Russian President Vladimir Putin appeared on stage at the 2024 BRICS summit holding what looked like a physical banknote, a prototype, a symbolic gesture that sent shockwaves through currency markets worldwide. But that symbolic banknote represents something very real. Behind it sits over 6,000 tons of gold accumulated by BRICS nations. That's roughly 20% of all global central bank gold reserves. Russia holds 2,336 tons. China holds 2,299 tons. India holds 880 tons. Together, Russia and China control 74% of total BRICS gold reserves. These aren't small numbers. These are the building blocks of a currency system backed by something physical, something that can't be printed, something that doesn't require a Federal Reserve signature to have value. Analysts suggest this gold accumulation isn't random. It's strategic positioning for what many economists argue could be the most significant monetary shift since Bretton Woods. The pattern became undeniable when central banks globally purchased over 1,000 tons of gold annually from 2022 through 2024. That's the longest sustained buying streak in modern financial history. Poland added 90 tons in 2024 alone. China extended its gold buying streak to 10 consecutive months. Kazakhstan increased reserves by 8 tons in a single month. These aren't countries hedging against inflation. These are nations building war chests for a financial system that operates outside dollar rails entirely. The technical architecture behind this shift tells you everything you need to know about how serious they are. BRICS Pay isn't some distant fantasy. It's a decentralized payment messaging system that's already been developed. The specifications are public. 20,000 messages per second capacity using distributed ledger technology. No mandatory transaction fees. Automatic transaction routing between participants. Most importantly, zero need for US dollars to settle trades between member nations. The system uses blockchain to tokenize gold reserves stored in vaults across multiple countries. Smart contracts verify reserves and execute settlements. Multi-signature authorization prevents unilateral actions. This isn't theoretical anymore. Former Russian ambassador Yuri Ashakov confirmed the system would use cutting-edge digital technology, including blockchain. Russian central banker Elvira Nabiullina stated that 159 countries have expressed interest in using it. Think about that number. 159 countries looking for alternatives to a payment system that Washington controls. That's not a fringe movement. That's a tectonic shift in how global trade could function. These countries represent economies tired of sanctions risk, tired of correspondent banking fees, tired of exchange rate volatility from currency conversions, tired of needing permission from New York to do business with each other. The motivation becomes crystal clear when you understand the sanctions playbook. When Russia was excluded from SWIFT following its invasion of Ukraine, the entire developing world took notes. If it could happen to Russia, it could happen to them. Iranian banks have been locked out. Venezuelan institutions face restrictions. Any country that crosses Washington's foreign policy objectives risks being cut off from the dollar system that underpins global trade. History shows that financial sanctions used to be economic weapons of last resort. Now they're deployed regularly, and emerging market central banks are responding by diversifying away from assets that can be frozen or seized by foreign governments. The gold component provides something traditional. Fiat currencies cannot deliver. Counterparty neutrality: when you hold gold in your own vault, you don't need anyone's permission to use it. There's no credit risk, no geopolitical strings attached, no possibility that your reserves get frozen because of a policy disagreement with Washington or Brussels. This matters enormously to countries that have watched the US seize Afghan reserve funds and freeze Russian assets. The European Central Bank confirmed that gold recently overtook the euro as the world's second most held reserve asset. That's not a small detail. That's a fundamental vote of no confidence in paper currencies controlled by foreign central banks. But here's where it gets complex, and where most analysis falls apart. The BRICS alliance isn't monolithic. India's Reserve Bank governor stated in December 2020 that de-dollarization is part of de-risking trade dependence on any single currency. Prime Minister Narendra Modi emphasized that BRICS is non-Western, not anti-Western. These are important distinctions. India wants options, not revolution. China, meanwhile, operates the world's largest manufacturing export machine and has accumulated trillions in dollar reserves. Completely divorcing from the dollar system would require untangling supply chains built over decades. That's not happening overnight. Brazil's president, Luiz Inácio Lula da Silva, has been vocal about creating a BRICS currency. Russia obviously wants alternatives given its sanctions predicament, but China and India have been noticeably quieter on unified currency proposals. The tensions between BRICS members aren't trivial. India and China have border disputes. Saudi Arabia, which was invited to join, has taken a cautious approach, balancing relationships between Western nations and BRICS members. Iran faces one set of constraints. UAE faces completely different economic incentives. These aren't natural allies with aligned interests. They're countries of convenience, finding common ground in reducing dollar dependence. The proposed currency, called the unit, represents a compromise between competing visions. Analyst Jim Rickards describes its structure as 40% gold by weight and 60% based on a basket of BRICS currencies. That means it won't be purely commodity-backed like historical gold standards. It won't be pure fiat like the dollar. It will be a hybrid designed to give participating nations flexibility while anchoring value to physical reserves. The gold component means the unit's value rises as gold prices rise. That creates powerful incentives for BRICS nations and other countries to accumulate gold as insurance against this monetary transition. Markets respond to incentives, and the incentive structure here favors precious metals accumulation at a scale we haven't seen since the 1970s. If even 50% of intra-BRICS trade shifted to such a system, economists estimate cost savings of 1 to 2% per transaction. That might not sound like much until you realize intra-BRICS trade accounted for 37% of their total transactions in 2022, up 56% since 2017. We're talking about billions of dollars in annual savings from reduced currency, conversion costs eliminated, correspondent banking fees, and lower regulatory compliance expenses. Those savings don't disappear. They fund infrastructure projects. They enable lower borrowing costs. They make BRICS economies more competitive relative to Western counterparts that remain locked into dollar-denominated trade. The new development bank based in Shanghai has already formalized multi-billion-dollar cross-border settlement hubs specifically designed to facilitate trade between BRICS nations. This provides loan guarantees for infrastructure projects across the BRICS sphere, enabling development without reliance on Western-denominated institutions like the World Bank or International Monetary Fund. Russian Finance Minister Anton Siluanov confirmed these systems are operational, not planned, not theoretical. Operational, the infrastructure exists. The question isn't if alternatives to dollar dominance are technically feasible. The question is how quickly adoption accelerates and what percentage of global trade migrates to these parallel systems. President Trump recognized the threat immediately. In November 2024, he posted on Truth Social demanding that BRICS nations commit to not creating a new currency or backing alternatives to the dollar or face 100% tariffs. By January 2025, his first day in office during his second term, he repeated the threat. In February, he stated that BRICS is dead and claimed the organization went silent following his 150% tariff threat. But the evidence suggests otherwise. At the 17th BRICS Summit in Rio de Janeiro in July 2025, the language emphasized ongoing financial cooperation proposals. The communiqué mentioned local currency financing through the new development bank and enhanced payment systems. These weren't abandoned initiatives. They were reframed as continuing deliberations rather than immediate implementations. Russian Foreign Ministry spokesperson said BRICS framework is non-confrontational and constructive, a viable alternative to a world living by someone else's alien rules. Putin himself walked back aggressive de-dollarization, rhetoric stating the goal isn't to reject the dollar outright but to counter its weaponization. The priority he emphasized is building alternative pathways. That's strategic ambiguity. That's political cover for continued infrastructure development without triggering immediate Western retaliation. When your opponent threatens tariffs, you don't abandon your strategy. You make it harder to target by diffusing it across multiple bilateral agreements and technical standards discussions that happen outside the spotlight. The Enbridge project provides a template for how this could work. Under Bank of International Settlements, auspices from 2021, the central banks of Thailand, UAE, Hong Kong, and China tested cross-border transactions using central bank digital currencies. In January 2024, some $90 million in digital yuan was used by PetroChina to purchase UAE oil. The ECNY was settled with the seller's bank accounts in China in digital yuan, where it converted to normal yuan. That transaction happened. It didn't require dollars. It didn't go through SWIFT. It proved the concept works at scale for actual commodity trades between major economies. Chinese state media stated in October 2020 for that new BRICS plans would likely draw on lessons learned from Enbridge. The infrastructure isn't starting from scratch. It's building on tested frameworks that have already demonstrated viability. Here's what the financial establishment doesn't want you to understand. Dollar dominance isn't maintained by economic superiority anymore. It's maintained by network effects and the massive switching costs of moving to alternatives. Every invoice written in dollars, every bond denominated in dollars, every central bank reserve held in treasury securities, every commodity contract priced in dollars. These create self-reinforcing loops that make dollar use rational even for countries that would prefer alternatives. Breaking those loops requires coordinated action across multiple dimensions simultaneously. That's exactly what BRICS is attempting. The statistics reveal the scope of entrenchment. 88% of foreign exchange transactions worldwide involve the dollar in one leg of the trade. About half of all cross-border bank lending and international debt securities are issued in US dollars. 60% of foreign exchange reserves maintained by central banks globally are held in dollars. Nearly 60% of international debt securities and cross-border loans issued in offshore funding markets are denominated in USD. At least 85% of trading in spot forward and swap markets features the USD. Those aren't small margins. Those are monopolistic levels of dominance that took 70 years to build. They won't crumble overnight, but they don't need to crumble overnight to create massive consequences. If the dollar's share of reserves falls from 58% to 45% over the next decade, which many reserve managers surveyed by OMFIF anticipate that represents a 13 percentage point decline. Applied to $12.7 trillion in total foreign exchange reserves, that's roughly $1.6 trillion. Dollars of reduced dollar demand, that money has to go somewhere. It goes into euros, it goes into yen. It goes into Australian dollars, Canadian dollars, Korean won. But most importantly for this story, it goes into gold and into yuan-denominated assets as China's economy continues expanding and its bond markets deepen. Each marginal shift away from dollars reduces network effects, makes alternatives more viable, creates momentum for further diversification. The Federal Reserve's own analysis acknowledges this gradual erosion. Their 2025 edition report on the international role of the dollar states the dollar's share declined from its peak of 72% of reserves in 2001. They note very gradual movement away from dollar dominance and a rising role for non-traditional currencies of small, open, well-managed economies enabled by new digital trading technologies. Those non-traditional currencies are exactly what OMFIF's Global Public Investor Report highlighted. Reserve managers are diversifying into Australian dollars, Canadian dollars, Swedish krona, South Korean won, not because those economies rival America's size, because those currencies provide attractive yields, lower geopolitical risk, and increasingly liquid markets, thanks to automated market-making systems and digital settlement infrastructure. But the Federal Reserve report also makes a critical observation. Absent any large-scale lasting disruptions which damage the value of the US dollar as a store of value or medium of exchange, and simultaneously bolster the attractiveness of dollar alternatives, the dollar will likely remain the world's dominant international currency for the foreseeable future. That's the establishment view. The question BRICS poses is whether coordinated action by nations, representing 45% of global population and 40% of GDP, constitutes the large-scale lasting disruption that changes the calculus. History shows reserve currency transitions happen slowly, then suddenly. The British pound sterling remained dominant for decades after the United States overtook the UK as the world's largest economy. Recognition is important in determining reserve currencies. Momentum builds gradually until it reaches inflection points. The Shanghai Futures Exchange, launched March 1, 2020, represents one of those potential inflection points. This exchange facilitates physical gold trading with immediate delivery on a T+0 settlement basis rather than delayed settlement common in Western markets. That fundamentally differs from London Bullion Market, Association, and COMEX models, which rely heavily on paper contracts with limited physical delivery. When you can take immediate physical possession of gold in Shanghai, you're not trading derivatives. You're trading actual metal that creates price discovery mechanisms independent of Western exchanges. It attracts liquidity from participants who want physical backing rather than contract promises. Over time, if Shanghai pricing diverges significantly from London or New York, pricing it forces a reckoning about which market reflects true supply and demand for physical gold versus which market reflects paper speculation. Consider the implications if oil-producing nations start accepting yuan for crude oil and immediately converting a portion into physical gold through Shanghai exchanges. That bypasses dollars entirely. Saudi Arabia, the UAE, and Iran all either joined BRICS or were invited to join. With these oil producers, BRICS countries now account for approximately 44% of world crude oil production. If even a fraction of that production gets invoiced in currencies other than dollars, it reduces global dollar demand. Those dollars come back to the United States, creating inflationary pressure. The only reason America can run massive budget deficits and maintain low borrowing costs is that global demand for dollars allows the Federal Reserve to export inflation. When that demand decreases even marginally, the constraint on deficit spending tightens, interest rates rise, debt service costs explode. The fiscal situation that looks manageable today becomes unsustainable. Former President Trump's tariff threats reveal awareness of these dynamics. 100% tariffs on countries that pursue BRICS currencies. Sounds extreme, but it's economically rational if you understand what's at stake. Reduced dollar demand means reduced ability to finance government spending through treasury issuance. It means higher interest rates. It means the exorbitant privilege that allows America to borrow in its own currency at low cost starts eroding. But tariffs create their own problems. They accelerate the very de-dollarization they're meant to prevent by making trade with America more expensive and therefore less attractive. They push fence-sitting nations toward BRICS alternatives. Kremlin spokesperson Dmitry Peskov stated that if the U.S. uses economic force to compel countries to use the dollar, it will further strengthen the trend of switching to national currencies. That's not rhetoric. That's accurate analysis of incentive structures. The euro provides a cautionary tale about challenging dollar dominance. When the euro launched, many analysts predicted it would rival or surpass the dollar as a reserve currency. The eurozone represented a massive economy, deep capital markets, institutional frameworks. Yet the euro's share of reserves has remained around 20% for 2 decades. Why? Because political fragmentation undermines confidence. Because the European Central Bank lacks the unified fiscal backing of a true federal system. Because in times of crisis, investors flee to dollar safety, not euro safety. BRICS faces even larger coordination challenges. These aren't neighboring countries with shared legal systems and integrated economies. These are geographically dispersed nations with competing interests, different regulatory frameworks, and in some cases, mutual distrust. India's unified payment interface and Russia's Mir system already exist as domestic alternatives to Western payment networks. Integrating them with Chinese SIPs and creating interoperability across all BRICS members requires complex standardization efforts. Every member nation has its own financial regulations, its own supervisory authorities, its own monetary policy objectives. Getting them to subordinate national sovereignty to a shared currency system is the same challenge that Europe faces with the euro, except BRICS doesn't have decades of integration and treaty frameworks to build on. That's why the unit, as proposed, is designed to preserve monetary sovereignty while enabling cooperation. National currencies remain. They just get weighted against each other with gold as a benchmark. That's politically easier than forcing countries to abandon their monetary independence entirely. The gold linkage solves the trust problem that pure fiat alternatives can't. When trade between Russia and India expanded after Western sanctions, Russia didn't want to accumulate rupees because it has limited demand for Indian exports. India didn't want to hold rubles for similar reasons. Neither currency inspires confidence as a store of value outside its home economy. But both countries will hold gold. Both countries will hold yuan to some degree, given China's role as manufacturer to the world. A settlement system where trades clear through a gold-weighted mechanism means countries don't need to trust each other's monetary policy. They need to trust that gold retains value and that the technical infrastructure accurately tracks ownership and settlement. That's a much lower trust threshold than asking Russia to hold rupee reserves or asking India to hold ruble reserves. Distributed ledger technology enables this low-trust coordination. When gold reserves backing transactions are distributed across multiple vaults in multiple countries with cryptographic verification and smart contract settlement, you eliminate single points of failure. You prevent any one nation from manipulating the system. Multi-signature requirements mean unilateral actions become impossible. Every transaction gets recorded on an immutable ledger that all participants can audit. That transparency is how you build confidence in a system where members don't fully trust each other. It's not about faith in institutions. It's about verifiable mathematics and code that executes automatically based on pre-agreed rules. The timeline matters enormously here. BRICS isn't announcing a gold-backed currency tomorrow. Official statements from the 2024 Kazan Summit and subsequent meetings emphasize ongoing deliberations, feasibility studies, pilot programs, and phased implementation. Regulatory frameworks need harmonization across member nations. That takes years. Limited commercial deployment for select trade categories might happen in 2026 or 2027. Gradual expansion to broader commercial usage follows. Full implementation, if it happens, could be a decade away. But markets don't wait for full implementation. Markets price in expectations of future shifts. If participants believe de-dollarization trends will continue, if central banks keep buying gold, if BRICS nations keep building alternative infrastructure, then investment flows adjust today based on tomorrow's anticipated reality. Gold prices hit record highs in 2025, partially because central banks keep buying when monetary authorities purchase over 1,000 tons annually for 3 consecutive years. That's not speculation. That's structural demand that supports higher price floors. If BRICS successfully implements even partial adoption of gold-linked settlement mechanisms that demand increases further, mining supply is relatively inelastic. New deposits take years to develop. Recycling provides some supply, but most gold ever mined still exists in some form. When central bank demand rises and investment demand rises simultaneously because investors' position for monetary system changes, you get sustained price appreciation that looks like a bubble to people who don't understand the underlying drivers, but is actually rational repricing based on changing demand fundamentals. Here's the part that should concern dollar holders. The transition doesn't require BRICS to succeed completely. It just requires enough success to fragment the global payment system into competing blocks. A world where 40% of trade happens in dollar-denominated systems and 40% happens in BRICS-linked systems and 20% happens in euro or other regional arrangements is a world where the dollar's monopoly is broken. Network effects reverse. Instead of everyone using dollars because everyone else uses dollars, you get regional clusters using whatever system dominates their geography. Asian countries trade in yuan-linked mechanisms. African countries that are Chinese creditors use yuan to service debt. Oil producers invoice in multiple currencies depending on buyer location. Each fragmentation reduces dollar demand at the margin. The U.S. currently benefits enormously from dollar's role as global reserve currency. It means chronic trade deficits are sustainable because other countries need dollars for reserves. It means the federal government can run massive deficits because foreign central banks buy treasuries to hold dollar reserves. It means American consumers benefit from cheaper imports because dollar strength makes foreign goods affordable. If those advantages erode, even partially, the adjustments are painful. Trade deficits become unsustainable. Budget deficits require domestic savings to finance at higher interest rates. Import prices rise, creating inflation. Living standards decline for anyone whose wealth is primarily in dollar-denominated assets that lose purchasing power. The establishment response has been to downplay these risks, to emphasize the dollar's continued dominance, to point out that reserve transitions take generations, not years. All of that contains truth, but all of it misses the core dynamic. When the world's largest oil producers, largest manufacturers, largest population centers, and fastest-growing economies coordinate to build alternatives, the timeline accelerates. When technology enables settlement mechanisms that were impossible 20 years ago, the switching costs decline. When geopolitical tensions make reliance on dollar systems risky, the incentive to diversify intensifies. These forces compound. They don't cancel out. What happens next depends on execution. Can BRICS nations overcome internal disagreements to implement functional alternatives? Can they build systems that offer genuine advantages over dollar networks in cost, speed, and reliability? Can they attract enough participants to create competing network effects? Those are open questions, but the fact that they're trying with this level of seriousness and this much gold backing should tell you everything about how non-Western nations view dollar dominance. They view it as a vulnerability, not a feature. They view it as leverage Washington uses against them. They view alternatives as worth building, even if success is uncertain and timelines are long. History doesn't repeat, but it rhymes. The British pound's decline as reserve currency took decades, but the process was irreversible once it started. The dollar might maintain dominance for another generation. Or BRICS might accelerate a transition that historians will mark as the end of the post-World War to monetary order. Either way, the chess pieces are moving, and gold is at the center of the board.